Something happened quietly last week that most XRP analysts completely missed, and it has nothing to do with the price chart. While everyone was watching XRP get rejected at $1.30 and arguing about whether we're heading to 90 cents, 7 institutional ETFs were pulling in money. 149 out of 151 trading days. Positive inflows, no headline, no announcement, no new catalyst, just money coming in quietly every single week. So let me ask you something before we look at a single chart today. If institutions were selling XRP, would that pattern exist? And if they're not selling, if they're actually buying through a 68% correction with no news, what does that tell you about what they know that retail doesn't? Because the visible story right now is a rejected price chart. The real story is something else entirely. And that's what we're getting into today. Let's start with where price actually is right now, because this matters. XRP got rejected at $1.30. That's the fact on the chart. After briefly testing that major resistance zone, price came back down hard and entered a consolidation phase. Right now, we're sitting in a tight accumulation range around $1.14 to $1.16 on the 4-hour chart. Analyst Deanna has been mapping this closely. Price is stabilizing above recent lows. The Ichimoku cloud ahead is flattening, which means selling pressure is losing grip. Short-term moving averages are starting to converge. Volume has cooled, and if you've watched crypto long enough, you know that's exactly what tends to happen before the next expansion move. The upside path, if price reclaims $1.30, the next targets are $1.36, then $1.42, then $1.47. Clear $1.50 to $1.55, and analysts put $1.64 on the board, possibly higher from there. The downside, if momentum fails here, we could revisit $1.19 or even 90 cents. And I'll be straight with you. There are credible chart analysts who have been calling for sub-dollar XRP for a while now. That scenario would hurt. People who mentally set a dollar as their exit line would actually leave. Price could flush, then bounce back. That's usually how it plays out. But a lot of people would be shaken out first. That's the chart. That's what's visible on the surface. But charts don't tell you why money keeps flowing in when price is falling. For that, you have to look somewhere else. Here's the part most people skip. XRP's 2-month RSI just came back to the 50 level. Historically, that zone marks the transition between reset and expansion. Hold at 50 and you get momentum returning. Reclaim 55 and strength is building. The macro RSI target during a full bull cycle is 80. That's what analysts are pointing at on the longer time frames. But the monthly RSI picture is more interesting than the number itself. AgraCrypto flagged something that deserves real attention. The monthly RSI is still falling. On paper, that reads as bearish. But here's the pattern from the last 14 years of XRP history. At every major macro bottom, this is exactly what the setup looks like. Price prints a lower low. RSI starts forming a higher low at the same time. That's called hidden bullish divergence. It's how macro reversals are born, not from excitement, from fear. AgraCrypto expects one more emotional price flush before RSI stabilizes, and the divergence structure builds what it needs for the next macro move. Fear creates the bottom. Divergence confirms it. Moon Lambo put it simply, every single time in 14 years that XRP's RSI has been this low, it marked the bottom. Every time. The argument that this time the asset is somehow broken after surviving a major legal battle, after building institutional infrastructure, after launching 7 ETFs, that argument doesn't hold up under scrutiny. Now timing enters the picture. A chart making the rounds right now shows XRP in a tight wedge pattern. Technically, wedges build pressure. At some point, the price breaks one way or the other, and the historical calendar case for when that happens is pretty clear. July. Since 2020, XRP has had 5 straight green Julys. Not slightly green, 48% gains, 47% gains, consecutive. June has historically been rough for XRP holders. Lower volume, slower news cycles, people on vacation, less happening. Crypto tends to go quiet in June, but July tends to deliver for this asset in a way that's been consistent enough to be worth watching. Now, think about what's sitting in the background heading into this July specifically. 7XR ETFs live and active in the United States. DTCC signaling more blockchain integration announcements. Clarity Act legislation in process. Ripple closing acquisitions and expanding infrastructure. And a price chart sitting in a wedge that technically wants to break. It only takes one announcement to change everything. One. And we're sitting on a list of potential announcements that haven't been made yet. Keep that in mind. Let's come back to the number from the top. Bitwise's XRP ETF has posted net inflows on 149 out of 151 trading days since launch. 98.7% win rate, only 2 outflow days in 7 months, and May saw 0 fresh catalysts, no announcements, no regulatory clarity, no price movement worth talking about. Money kept coming in anyway. What does that tell you? Traditional finance investors are allocating to XRP in the background. Not because of a pump or a news cycle. They're buying it the same way they buy an index position, consistently, regularly, because their thesis is long-term and they're not watching the hourly chart. Their time horizon is different from retail. Their conviction is expressed differently. And their buying doesn't move price the same way a Binance trade does. It builds slowly underneath the surface. Chad Steingraber noted over the weekend that XRP shorts are nearly at zero and liquidations are quiet. Nothing is really happening. The shorts in the range aren't making money. The longs who bought the correction are holding, and institutions are quietly adding. Now put one more variable into this picture, the Clarity Act. If stablecoin and digital asset regulation gets defined framework, the buyer pool doesn't just expand a little. You're potentially opening the door to pension funds, sovereign wealth funds, insurance companies, pools of capital that make the current ETF inflows look small. Quiet accumulation plus depleted short interest is the setup that tends to precede significant moves. The question is, what actually lights it? Here's something that doesn't get talked about enough. The XRP rich list shows 7.4 million wallets holding less than 5,000 XRP. The single largest group, nearly 4 million wallets, holds just 20 XRP. These are dust wallets. People who tested a DeFi protocol once, leftover exchange accounts, someone who bought $30 worth in 2021 and never came back. These aren't real positions. Once you strip those out, the actual holder base is surprisingly small. Only 70,000 wallets hold between 25,000 and 50,000 XRP. Only 11,000 wallets hold between 75,000 and 100,000 XRP. Think about what that means for an asset being positioned as global settlement infrastructure. The number of people seriously positioned in this is tiny. The asset hasn't been discovered at scale yet. If you believe in any version of the use case, and the case for it has only expanded over the last 2 years, then current distribution means early holders carry real leverage when adoption scales up. The people who've been in this 8 to 10 years aren't asking whether XRP goes up, they're already beyond that question. This is where things get uncomfortable for people who've been following XRP since 2017 or 2020. You probably bought XRP because of a clear thesis. Ripple was going to replace Swift. XRP was the bridge currency. Cross-border payments faster and cheaper than correspondent banking. That was the pitch. And it was a real pitch, not hype, actual infrastructure being built. That story isn't wrong, but it's now the smallest version of what XRP is becoming. Verson laid this out clearly. XRP is no longer just a bridge token for remittances. It's being positioned as a neutral, high-performance public settlement layer. Institutions are plugging into it directly, not as an experiment, but to reduce their dependency on slow, expensive legacy banking rails. That part was always the plan. But here's what wasn't in the original plan. Institutions are now testing XRP and the XRP ledger for tokenization, DeFi, credit markets, and collateral management. Ripple's recent acquisitions, G Treasury and Ripple Prime, are building entirely new utility cases on top of the asset. Every new use case is a new demand driver. Every new demand driver expands the total addressable market. When you bought XRP, you were buying payments infrastructure. What you may actually be holding right now is a stake in the emerging backbone of a new credit market system. Those are not the same investment. The numbers that made sense in 2020 weren't built to value this version of the asset. The asset is evolving faster than most holders' mental model of what it is. That gap between what it actually is and what people think it is, that's usually where price discovery happens. Let's zoom all the way out. The DTCC processes the bulk of US securities transactions. They've already signaled more blockchain integration announcements are coming. New L1s, new L2s. Their existing patent work references both XLM and XRP. When DTCC announced its XLM relationship, the market noticed. But XLM has no ETFs. The institutional infrastructure to absorb that kind of announcement quickly didn't exist. The on-ramp wasn't there. XRP is completely different. 7 ETFs already active in the United States. Institutional demand infrastructure already built. The on-ramp is already there. So when a DTCC announcement eventually comes around XRP, what actually happens? You don't just get a price move. You get ETF inflows accelerating on top of a direct buy market that's already active. You get media coverage for an asset that's already inside more regulated, accessible products than any non-Bitcoin, non-Ethereum crypto in history. You get retail FOMO stacking on top of institutional flows that were already there. That's a different event than anything XRP has seen before. 7 ETFs change what an announcement can do to this market structure. And DTCC said the announcements are coming. This one hasn't happened yet. Let me put this in the longer context for a second because it matters. XRP has been through 3 major accumulation and expansion cycles. The first explosion was 2014, then a long wait for 2017, then 2020 to 2022, then the most recent run in late 2024 into 2025. Right now in 2026, we're in the post-run accumulation phase. The 68% correction from the $3.66 cycle high brought price back into the $1.10 to $1.30 range. Higher lows on the weekly and monthly charts are still intact. The higher timeframe structure still points upward. Volume is rising slowly as utility expands on the network. The weekly chart shows XRP defending the $1.10 to $1.30 accumulation zone consistently. The correction phase may be approaching its final stages. Resistance from here, $2.00 to $2.50 is the first major test. Then $3.66 is the cycle all-time high retest. Then $5 to $6 is price discovery territory. Then $8.17 at the major Fibonacci extension, and the long-term channel target sits at $17.15. Strong macro support below is at the 40 cents to 60 cent zone. That would be painful for anyone who's been here a few years, but the market has already survived a 68% correction. Historically, major extensions in XRP have begun when most investors had already lost interest. That's usually when things turn. Here's the assumption most XRP holders are still running on. XRP is a speculative crypto asset. When Bitcoin drops, XRP drops harder. The 68% correction proves the old pattern holds. That part is true. For now. But something is changing under that pattern, and I think it's being seriously underestimated. While retail was selling the correction, 149 out of 151 institutional ETF trading days were positive. While chart analysts were debating 90 cents, Ripple was closing acquisitions and building infrastructure. While the chart was down 68% from its high, institutional money was adding to positions. The old rule in crypto, price drops, everyone suffers equally. The new reality forming, XRP has an institutional accumulation pattern that runs independently of retail sentiment cycles. Institutions are not behaving like retail investors. They're not reacting to daily chart moves. They're expressing long conviction through consistent allocation. If XRP was just a speculative token, that ETF pattern would not exist during a 68% drawdown with no catalyst. That's not what speculative token buyers do. That's what infrastructure investors do. The rule is changing. XRP may be in the process of being repriced away from the speculative crypto category and towards settlement infrastructure. Those two categories get valued differently, they trade differently. The ceiling on the second category is a different number than the ceiling on the first. One creator this week said he didn't believe XRP could ever reach $100. He's been making content on this asset for years, and I get it. It sounds impossible from where we're sitting. But do you actually know how much money moves on chain in the next 10 years? Do you know what the XRP ledger will process in 2030? Nobody does. So I'm going to hold off on setting ceilings. Let's bring this back to where we started. XRP got rejected at $1.30. The chart is grinding in a tight range. Monthly RSI hasn't confirmed a bottom yet. One more flush might still be coming before the divergent structure builds out. June has historically been rough. These are all true. But look at what's sitting in the picture at the same time. 149 institutional inflow days out of 151. A DTCC announcement that hasn't landed yet. Clarity Act legislation still in process. Ripple Prime and G Treasury building credit market infrastructure directly on the ledger. 7 ETFs providing institutional access that didn't exist in the last cycle. A wedge pattern building pressure. 5 straight green Julys is a historical signal, and an asset that started as a payments bridge and is now being tested as backbone infrastructure for tokenization, collateral management, and DeFi. The visible story is price is stuck in a range and the chart looks uncertain. The real story is the asset that gets announced into DTCC integration will not be the same asset most people bought in 2020. The infrastructure being built right now is changing what this asset actually is. The institutional demand being expressed through 149 straight ETF inflow days is telling you something that the price chart alone doesn't say. July may deliver. Or it takes another month. That's noise. What does this asset look like in 3 years, when the infrastructure being built right now is actually running at scale? Because I don't think anyone in this space has a real answer to that question yet. And when the market figures it out, you're not going to have time to position. Think about that. See you next time.